Hello everyone and welcome back to Explain the Charts. It is March 23rd, 2026, and we are covering the S&P 500 during a period of extreme geopolitical volatility. The biggest news hitting the wires today is that President Trump has postponed planned military strikes on Iran's energy infrastructure, citing very good and productive talks between the two nations. This has caused an immediate relief rally in U.S. stock futures, which are currently jumping about 2% after a miserable 4-week losing streak. Previously, market anxiety was reaching a fever pitch as oil prices briefly touched $113 per barrel, but we are now seeing crude retreat back toward the $91 range. As we look at the daily chart for SPY, we can see the broader context of this correction. Looking at the daily candles from late 2025 into early 2026, the S&P 500 had been on a tear, peaking at a 52-week high above 700. However, the start of 2026 saw a series of lower highs and lower lows as inflation concerns and Middle East tensions began to weigh on investor sentiment. Just last week, specifically on March 19th and 20th, the index broke significantly below its 200-day moving average for the first time in over 200 days. You can see that long red candle on March 20th where SPY dropped over 1.5% to close at 6,506.48. Historically, breaking the 200-day moving average is a major bearish technical signal that often precedes a deeper market correction. Analysts have been warning of a 7% to 10% further downside if this level isn't reclaimed quickly. The current news of de-escalation is exactly the catalyst bulls were hoping for to attempt a reclaim of that long-term trend line. Switching over to the 1-hour chart, we can see the sheer velocity of the selling pressure that occurred in mid-March. The market was characterized by heavy gaps down at the open as geopolitical threats escalated over the weekends. Notice the cluster of selling near the 6,750 level on March 11th and 12th, which acted as a short-term ceiling. On the hourly time frame, we see several attempts to find support, but each rally was met with heavy sell volume. The triple witching event on March 20th added to the volatility, with over $5.7 trillion in options expiring. The low reached on Friday near 6,447 proved to be a critical temporary floor where buyers finally stepped in. Let's zoom in further to the 15-minute chart for March 20th to see how the market closed before this weekend's news. Early in the session, SPY was under intense pressure, sliding from 659 down to that 644 level. However, look at the volume spikes in the final 2 hours of trading on Friday. The price began to curl back up, closing at 648.57, which suggested that some investors were already pricing in a potential de-escalation. When trading SPY in these conditions, these intraday reversals are key indicators of institutional dip buying. The immediate resistance we are looking at on this shorter time frame is the 660 level. Given the futures are up 2%, we are likely to open well above 660 today, potentially gapping over the previous support-turned resistance. Returning to the daily view, we have several scenarios to consider for the rest of the week. The bullish case is centered on a V-shaped recovery fueled by the 5-day pause and strikes announced by the president. If SPY can close back above the 200-day moving average and hold 6,600, we could see a fast move towards 6,750. Reasons to be bullish include the resilience of big tech earnings and the fact that oil has plummeted 7% overnight, which should ease inflation fears. On the bearish side, we must remain cautious about stagflation risks and the potential for talks with Iran to fail. If the market fails to hold the morning gap up and slides back below 6,500, it would confirm that the trend is still firmly down. Short-term traders should look for a hold above 6,550 on the hourly chart to stay long. Long-term investors are likely looking for a weekly close back above 6,700 to confirm that the worst is behind us. To recap the important price levels, 6,447 is our must-hold support, while 6,500 remains a major psychological level. On the upside, look for 6,600 as the first hurdle, followed by major resistance at 6,750 and 6,800. I believe there is a 60% chance of a sustained relief rally this week if the geopolitical news remains neutral to positive. However, a 40% probability remains for a dead cat bounce if the Federal Reserve remains hawkish due to the core PCE inflation data. Keep a close eye on the US dollar index and Treasury yields, as they are often leading indicators for the S&P 500's direction. Finally, please remember that this is not financial advice. Market conditions are highly volatile and unpredictable right now. Always do your own research and manage your risk carefully before making any investment decisions. Thank you for watching Explain the Charts, and we will see you in the next analysis.